This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. Today on the show, I have Gil Morales and Chris Kacher, and their new book is called In the Trading Cockpit with the O'Neill Disciples, and they're referring to William J. O'Neill of IBD fame. So I think it's a pretty good conversation, and sit back, enjoy, and this is my first new podcast for 2013. Enjoy. Hey, Chris, how are you?
I'm good, Mike.
Nice to meet you.
Nice meeting you, too. Gil should be on, because I've called him as well.
Okay.
Here I am.
Uh-oh.
Right here.
Hey, Gil, what's up?
Hey, Michael, how's it going? Not too much. Are you back from Thailand?
No, I'm leaving February 1st, and it's,
oh, okay.
I'm going for 5.5 months, and it's more than just Thailand.
Oh, cool.
Yeah,
So you're going throughout Asia then?
Yeah, I'm covering all my bases. So, hey, Chris, what's the proper pronunciation of your last name?
Kacher.
Kacher. Okay, we were debating. Yeah. Okay. Well, guys, I'm going to jump right in, and because I think I have the most important question that I could possibly ask, especially to ask two technical trend type trading guys, and feel free to jump in. The fiscal cliff. This is the most important thing on the planet. I mean, the fiscal cliff. I've heard this for a freaking month. The fiscal cliff. So, how do we begin to indoctrinate all those people out there? Before we even getting into discussing your new book, which we are going to discuss today, which is called In the Trading Cockpit with the O'Neill Disciples, how can we begin to get people to understand that all of this nonsense and news about the fiscal cliff that's been drumming in our heads for weeks, months on end is kind of not how you make money? Where do we start?
Well, I think, first of all, the politicians out there and governments, the central banks, have a very good spin system. So they give people false comfort by saying that they're rescuing the economy from recession by printing money, because ultimately that will be good for the stock market, good for commodities. It's a very misleading impression that they're putting upon the American people, as well as Europeans by the ECB and the good people of the UK by the Bank of England. And ultimately, there's a high price to pay for all this money printing. There always has been a high price to pay. And what we're seeing right now is a race to zero among the dollar and the euro and the pound, because all of those countries, all of those regions are printing money en masse in the form now of what we call QE infinity. And they plan to leave interest rates as low as possible until things get back on track economically, but that could be still 2 or 3 years off. And then there's a big price to be paid for all of this money printing, because if you look at the economy like a patient on the doctor's table, the patient's got cancer, but instead of dealing with the cancer, you're feeding the patient more morphine in the form of quantitative easing. And ultimately, we know what happens to a cancerous patient that's just injected full of drugs.
Well, Chris, I share your view on that issue, on how you just described it. But let me take it a step further where I really want it to go, which is, even if what you outlined is 100% true, and I think most rational people that have got their eyes wide open would agree, if the Dow goes from 13,000 to 26,000, you're not going to be sitting on the sidelines.
We always follow the trend, and we don't question it. And over history, over decades and decades of market data, ultimately, the trend is your friend. And if you try to over-intellectualize and think you're smarter than the market, and that means you sit out, you could end up missing a very vibrant trend, much as we saw in the end of 1998 and, of course, in 1999, when we had some of the most fierce, ferocious, upward trending markets in the history of the NASDAQ, certainly. So we don't argue with the trend, and we look at the market in a real-time basis, day to day, and we make our decisions in real time based on what information the market is feeding us.
Gil, did you want to add, why don't you add there, Gil? Why don't you to
I
what
would
I was
say, you're asking, the question you're asking seems like with all this quantitative easing, how do you make people understand that this is not how you make economies grow? And how do we look at it as technical traders looking for a trend to follow? And I would say that what it's really done is create a lot of distortion in the markets. I mean, when have you seen so-called recovery and economic recovery occurring when interest rates are at 0.25% and there's this massive liquidity being thrust literally into the financial markets? And I think a lot of that just it's really out of kilter, and it creates a lot of distortion. And in terms of finding trends to follow, I think it makes it a little bit more difficult. But I think you do have to hang out and look for the right entry point whenever that shows itself. It's hard to see a big trend on the upside developing here when there's so much that's just completely disconnected. And I'm listening to Howard Dean this morning talk about how we need to raise the debt limit in order to maintain the good faith and credit of the U.S. And that's a bizarre statement. But that seems to be the new normal. And so I think it does throw a wrinkle into the markets that you, at least as a trend follower, you somehow have to find a way around.
Well, let me keep drilling in, because I'm catching you guys as well-versed technical trading guys, and I'm looking at a population out there that, while the three of us and a good number of my listeners, we all kind of get the joke, so to speak. But I think a lot of people, they hear all these conversations, fiscal cliff, debt limits, QE infinity, and they just don't know what to make of it. So my issue really still, that what I want to lay out before we even get into your new book, is if the market, even if, Gil, you just talked about liquidity and all kinds of extra liquidity and whatnot, but if the market doubles from here, none of our views, none of y'all's views, the very cogent libertarian views that you've just outlined, that I tend to share a lot of, I don't think any of it matters if the Dow goes from 13,000 to 26,000, even if interest rates are at zero. So how do we get people to understand this kind of way that we're, put aside the economic thinking for a second. I'm just talking pure trading. How do we get people to wrap their arms around the idea that all this news, the fiscal cliff, the debt limits, QE infinity, is not necessarily relevant to making money?
Tell them to look at March of 2009, when all the headlines were about as bleak and pessimistic as I've seen in my trading history, and I would add perhaps about as pessimistic as I've read in the newspaper accounts in the early 30s. So we were scared out of our wits, and I think a lot of people, and ourselves included, we stayed on the sidelines. In fact, we shorted the market, thinking the market is going to continue to come apart. But what we failed to see was that you had quantitative easing, you had massive market manipulation by the Fed, and that caused the market to get back on track in a ferocious uptrend in 2009, where I think the Nasdaq was up something like close to 70% in 1 year. And my market direction model had a great buy signal. It nailed the buy signal. I think it was on March 12th. And I converted it because I was so worried and so pessimistic that the market's going to be too volatile and it's going to fall apart eventually. And I decided I wanted to be on the short side, or at least in cash, and not get hurt when the market did finally collapse. Of course, it never did collapse, and everything just kept going higher. The other issue was that we always look at the performance of leading stocks, and there were no leading stocks that were doing well. March, April, May, June, July 2009. It was a junk off the bottom led rally, and that also fooled us because prior to 2009, good rallies are always accompanied by good leading stocks. So all of a sudden, this market manipulation threw a curve at us, because rules that we had stuck with for decades, that had proven out for decades, were no longer valid because of the manipulation.
Right. Well, yeah, it's I just find we're in this interesting world of writing and talking about and trading technical trading strategies, and I still just maintain that there's such a small percentage of the population that wraps their arms around what we do, and clearly, You guys are authors. I'm an author. So we're trying to put words into print to get people to understand this. And maybe that's a good segue to jump into your new book. And maybe Gil, maybe you can outline the premise, the reason why you guys have put this new title together, which is once again called In the Trading Cockpit with the O'Neill Disciples. And maybe you can even explain the title.
Well, I think the book itself kind of grew out of the first book that we wrote 2 years ago in 2010. And what we found also starting our website in August of 2010 and having this following, which brings about a lot of questions and people trying to understand what we're talking about. And so what we learned in that process, we apply in this book, but some of the more direct, dealing with where the rubber meets the road, so to speak, in terms of how we implement our methods. And so we decided to put in more real-time trading simulations, as well as some psychological self-examination that goes on, because we think that's a big part of it. And we've actually found that that's the biggest hurdle for people, is the psychology of trading. And I would just say that the whole book itself, we didn't even know we would write a second book like this, but that whole process just brought out so many questions and so many ways that we began to understand how people have difficulty understanding. And that was basically the essence of how this book came about. And I think so it is much more of a where the rubber meets the road in terms of the nitty gritty of dealing with the mechanics of implementing a system like ours.
Well, I noticed it's very engaging in terms of Q&A and exercises and charts. So you really kind of, it almost feels more like a course, so to speak. But let me jump in here and maybe Chris, you can run with this too. You guys talk about the OWL ethos, OWL, like the bird. So why don't you explain that and what goes behind it and where that acronym comes from and why it's so important to you guys?
You want me to handle this, Chris?
No, I could do it. I got this one. Well, O'Neill built upon the work of these three legendary traders. The OWL, the O stands for O'Neill, the L stands for Jesse Livermore, and the W stands for Richard Wyckoff. And there were others as well that were part and parcel of creating this system to invest in entrepreneurial-oriented growth stocks. Now, the essence of this investing style is to search for new blood. In other words, the innovative, new, fast-growing companies that create new products and services that will drive the leading edge of any economic growth phase. And these former leaders can be seen throughout every market cycle. We've got Apple most recently, which has been a long-term leader for many years. We had AOL in the late 90s. We had Cisco throughout the 90s. Back in the day, we had Microsoft. And then we also had things like Price Club and Walmart, Home Depot, and so on and so on. So you got these companies that grow very quickly and represent the lifeblood of fast-growing economies. And the system is designed to focus on the fundamentals. In other words, you could say it's a hybrid system where you're examining 50% of the strategy going into the fundamentals of the company. If the fundamentals check out such that this company does have cutting edge technologies or services, then you can screen for the technical aspect, because you don't want to buy a stock because it's got great fundamentals. You want to get in at the right entry point. So you always know, based on this chart pattern, your entry point, and you also know the exit point. But you only explore those once the fundamentals check out.
Do you guys want to go ahead and jump back and either one of you can jump in here and maybe describe for the audience out there that's not familiar with the three men that you just described, and maybe give a couple sentence synopsis for each so people have a handle on that, because these are mostly, O'Neill is still going, but the other guys they're no longer with us. So I think people out there might be curious why two men that are like this, we're talking over 100 years ago, why they're important today.
Well, I think a lot of O'Neill's thought, a lot of the commonsensical aspects of his system were derived from Richard Wyckoff, who started the Journal on Wall Street. Is that right, Chris?
It's a Magazine of Wall Street.
Right, Magazine of Wall Street, right. And he was also the one who initially wrote about Jesse Livermore, the famous trader, also known as the Boy Plunger, who started out at the bucket shops betting as a young boy. and doing well enough there that he was able to get himself some capital raised and then actually play in the markets. But these two men in the earlier part of the 1900s really put together some of the common sense aspects, such as cutting your losses, letting your winners run, not getting caught up by news, watching the price action only. And, Jesse Livermore would lock himself in his trading office with just him and the ticker tape. And so it became a very much a process of being in the now and simply watching what the tape is doing and insulating himself from all these noise, kind of going back to what you started out asking us about. And so, as I see it, Wyckoff, who wrote Stock Market Technique 1 and 2, and there are some other classic books that he's written. I would look at his author name and search on that on Amazon for a number of the books that he's written. To me, though, Wyckoff and Livermore sort of exemplified the overall ethos behind O'Neill's philosophy towards the market. And so that's how they figure. And I think a lot of O'Neill's work is derived from that, either consciously or subconsciously. And that was just my observation working with the guy for 8 years. And so we sort of see ourselves having our own influences. And of course, those would include O'Neill, Wyckoff, and Livermore. And so we come up with the OWL acronym, which is, cute. Maybe we could do some T-shirts and some licensed characters and such with it.
So let me jump in here though. So the best is this for me. I'm just a simple man. I'm just a simple man who needs to go to Asia for 5.5 months. Can I surmise a good part of the thinking behind these three men is basically, like you said, cut your losses, let the profits run, follow that trend. But a lot of people, and you guys mentioned this in your work, that your new book, is this reversion to the mean mentality. And I think for a lot of people out there, they might hear reversion to the mean, and that might be a little too highbrow for them. They might not necessarily understand the depth at what you're trying to get across. Why don't you guys run with that and how this reversion to the mean mentality can often be the kiss of death for traders and investors?
Well, I think that's embodying a very simple concept, which is O'Neill looks to buy new price highs. So when a stock is breaking out of a consolidation, in other words, at the high end of a range, of either an intermediate or longer term range, that's when he's buying. And so the reversion to the mean mentality would keep you from buying a breakout to new highs, simply because you would be observing this pattern of the stock going back and forth for several weeks or months. And the thinking would be that once it's gotten above that range, then it's too high, it's overbought. And so we'll have to revert back to the mean of the prior price pattern. And so there's a lot of that built into a lot of the thinking that people really get into that's destructive. Also buying cheap stocks or stocks that are coming down very rapidly. People trying to buy Apple at 630 as it's coming down from its peak a couple, 3 months ago, on the basis that, it was at 700, that's the mean, so it's going to revert back to that mean, therefore I can buy the stock. And so there's a lot of this mentality built into a lot of the sort of establishment thinking about the market and what's sold to people out there. And that's really what we mean when we talk about that.
And the converse also replies, because there's a lot of investors out there who love to buy cheap stocks. They think they're getting a good deal buying a stock that's priced at $5 that once upon a time was $25. But we all know that cheap can get cheaper and cheaper. Oversold can get more and more oversold. Recipe to the poorhouse over time.
Well, I'm looking at my assistant right here, and she held on to TVIX all the way down, right? Yeah, I think she did. I'm not really sure why. She's supposed to be listening to me, but anyways, let me. She's barking something back at me, but let me. As we talk about, we try and introduce people to this idea of following the trend and how to think about buying higher highs or selling lower lows. And you guys get into this in your book, that ultimately the trading psychology rears its head. And why don't you go ahead and maybe use the example of, I know you talk about it in your book, which is the idea of you must lose to win. And maybe from a psychological perspective, because look, a lot of people think, well, I need to, if I'm going to buy 10 stocks this year, 9 of them have got to be winners. They don't think about, they don't think like a venture capitalist, which is like, hey, I might make 19 bets and one of them will pay for all of them and the 19 are going to be losers. Why don't you explain from a psychological perspective this idea of losing to win?
Bernard Baruch once said the least important statistic is your percentage of gains versus losses in your trading account. And the reason is simple. It's all how you manage the winners. You can have lots of losers. In fact, if you look at our best years in the market, and this includes O'Neill's best years in the market, which would probably be 1999, 1998, his hit rate is still about 50%. Half the stocks he buys are losers, but he handles the losses very quickly, quick to cut losses. The gains, the stocks that are doing well, he will pyramid. He'll add to those positions. He'll really make them count when he's hitting a home run in the market. And all you need is 1 or 2 home runs every year to get over a 100% return. And he is the grandmaster of triple-digit returns in the market. Now, most people it's like psychologically comforting, I think, to lock in gains and have profits that you can show in your portfolio. But if you use that mentality when you approach the market, you're liable to sell something way too soon that could have ended up being a home run. Meanwhile, when a stock is a loser in your portfolio, you're less likely to cut the loser short and rather hold on to it, hoping it'll get back to break even. And that's a bit of a gambler's mentality, which also is a very fast path to ruin.
You want to add something there, Gil?
No, I think Chris pretty much nailed that right on the head, I think.
I mean, you guys are working with a lot of new traders these days. So, like, is that when you try and summarize in your own mind the let's say the top 5 pratfalls from a psychological perspective that people have towards figuring out how to pull money from the markets, how to extract money from the markets? So we got the idea of not focusing on percent accuracy and focusing more on the magnitude of your winners and losers. What other issues do you guys see from your perspective in dealing with clients from a psychological perspective that are things that the audience out there can maybe relate to and maybe work on themselves?
I think a lot of people bring emotionalism into the investment process when it's really not really rational or necessary. So, for example, in dealing with clients, if we do have a drawdown, we'll get emails where they're asking us, what do you have any comments to make? Can you say anything that'll make me feel better? And I always find that's interesting that they want us to coo to them and tell them something that'll make them feel better when that's really not part of the reality at all. So to me, it's interesting how people want to inject this certain emotionalism and how they feel about something into the process. And I think, getting back to your original question was, how do you teach people to let go of the news and simply watch the trend and the price volume action? And I think human beings by nature are not built that way. And to get people to do that, I think is a very, very difficult task. And it could actually even become someone's life's work, like your own, Michael.
Well, yeah, I'm shifting. I'm going to become a Buddhist monk soon. So that's
okay.
That phase of my life is over. You guys can take over this trend thing, and I'm going to go. I'm going to go plant Japanese flower gardens.
That actually might be our 4th book, Trade Your DNA for Wiley, where we are going to go into the spiritual realm of things. Hey,
well, listen, you'll have to make it over to Asia. I'm game to talk. I'm sure I'll figure something out if I return. If I return, we have to figure that part out. So, Gil, what else do you want to add about the psychological perspective and some of the things that you've learned and that people struggle with?
Let's see. I know those are some of the
mentioned drawdowns. I mean, part of what Gil was saying earlier. A good example would be if you're in a difficult environment like we've been in since 2011, very trendless and volatile, gap up, gap down, news-driven environment. You're going to have a drawdown. You're going to have a lot of losers. So it's key to cut those losers short. People get worn out. People will get worn out if you have 10 losers in a row. My market direction model is a great example. The first half of 2011, the model was not doing well. It had a typical drawdown for that type of pattern, which was, a trendless pattern, which is really the model's Achilles heel. In fact, that's any trend follower's Achilles heel is a trendless pattern. So by July, people were starting to throw in the towel, just kind of give up altogether. And then July came along, August, September, October, and the model nailed 5 great winners in a row in terms of timing the market. Now that made up, more than made up for all the little losses during the first half of the year. And so what happened, it was interesting to see that people would then jump on board, come back in, seeing how well the model was doing once again. But then the model started having false signals starting again in October. So you really have to understand the weaknesses and strengths of the system that you're going to apply to your own money before before getting on board. Otherwise, it's going to cost you money in the end, where you lose faith in the system, you exit the system, and then when the system does well again, you get back into the system only to lose more money potentially. And that sadly is what happened to people. Some people who did just that in 2011. The ones who obeyed the model signals for all of 2011 did very well. I mean, they were up despite the market being down, and they were up double digits too.
You know, I don't know how I follow the press. I mean, I'll catch bits and pieces here and there, but I have noticed that in some of the things that I'll occasionally read, that there is a lament that it seems the this time is different crowd is rearing its head. And I'm starting to notice that there's more and more of a cacophony of voices that are basically like, in the central bank we thou trust everything, and there's seemingly the people that, even people that have had belief in trend type approaches, trend type systems, are seemingly starting to feel like, well, maybe it's all changed. Maybe the centrally planned economy is where we're at. And as they always said, don't fight the tape, so to speak. But so, like, maybe I could get you guys to switch back into the economics for a second, because I think ultimately this can help people to understand where you guys can lay out. Like I said at the very beginning, I share your view, but you can lay out this kind of proper libertarian view about the econ. But I think watching what's happened in the last couple of years is case in point for why you want to follow trends and why you want to have a loss cutting strategy. Take from some of the things, I know I'm throwing a bunch of different thoughts at you, but just take that and run with that. Jump, well, faster.
When you said that this time is different, it's interesting because I've studied market history going back to the Civil War. I read hundreds of books. I've studied hundreds of periodicals going back to the source. Ed Sekoda always said, if you're going to study history, go get the original documents. Don't read something that was printed last week. So it's interesting that every time in history, when people start to say, okay, well, we're not, trend following is dead. I've heard that phrase, or I've read about people saying that over the decades a number of times. And of course, it never does die. Usually that's about the turning point. And I think that the last 2 years have been so brutal on people. We're already starting to see, people throw in a towel and just basically say, well, I don't know if we're going to get any more trends anymore. It seems like everything's manipulated. Therefore, why bother? And you see people just giving up altogether. Which is a shame, because ultimately trends exist because charts are human nature on parade, and we will get more trends in the future. We always have in the past. And so as long as human nature stays what it is, I think that trend following is going to be alive and well. It's just a matter of patience during periods like we've seen in the last 2 years.
So some of the voices out there, it's all changed, and they've got it. There's a guy that I will occasionally read who's a fundamental guy named John Hussman, and John seems to be throwing in the towel a little bit. Like, maybe we're in this now planned economy, and all the other things will eventually work their way out, and eventually there'll be some kind of a breakdown. But for right now, as far as he can see, it all looks like they've got it steady Eddie.
I think one of the mistakes people can make is in terms of mistaking what is an always changing market with the idea that something's changed, it's now different, that makes whatever you were doing before ineffective. I think investing is always a process of adjusting along the way, and I think we've even had to make some adjustments to our timing model along the way to try and deal with some of the changes that we've seen in the market, the way it trades. But you can go back to any market cycle, and they're not all exactly the same. I remember in the late 90s when we were making tons of money with internet stocks, and really throughout the 90s. I started in the business in 1991, and that was fairly fortuitous given the parabolic move that we had in the 1990s. But a lot of the older guys in the business who had started, say, in the 80s or even in the 70s when things were much more difficult, they could not comprehend what was going on in the market. And so the way they dealt with it psychologically is they just passed it off as, oh, this is something different. It's not normal. It's not the way things should be. Stocks going up this fast, it's crazy, and it's just not something that is normal or part of any kind of investing reality. But it was very much part of a reality of making a lot of money in the markets if you could see what was going on. And we benefited from the fact that Chris and I basically started in the markets in the early 90s. So we grew up essentially during this period in the 90s where you had a parabolic market and big corrections set up again. The market bottomed and took off again. You had new leadership, and it was just a constant fertile ground of just new leadership driving this big bull market in the 90s. Now in the 2000s, we've run into problems in terms of trying to comprehend what's going on psychologically, because the 2000s have been more of a sort of a secular sideways market like you had in the 70s, and we never lived through any of that. So where we might say, oh, the 2000s are different and there's something different. Well, yes and no. Things are always changing and evolving, but I think as trend followers, you definitely have to be attuned to what's going on in the markets in terms of the price volume action. And if it requires adjusting your methods along the way, then that's what you do. And I think we've come up, things like the pocket pivot buy point is a way to gain an advantage. And Chris came up with that in, what was the year, 2004, 5, or 6?
2005, because 2004 and up to that point in 2005 were compressed sideways markets that were trending, but they were grinding markets. They were markets that ground higher reluctantly. So they would take 4 steps ahead and then 3 steps back. And they kept doing this. They'd wear you out, and base breakouts just were failing miserably. Not like they were when they were working brilliantly prior to this decade, this last 10 years. So it was a wake-up call that something's not right, something needs to change, and I went to the drawing board and came up with the pocket pivot concept as well as the viable gap-up concept. And that also evolved into the 7-week selling rule. Because obviously, if we're buying anything, you need to always know your exit points.
Well, I only want you to go into so much on those because they've got to buy the book if they want all the details. We got. I am a capitalist here, and I know you guys are capitalists. And there's a lot of people out there that want to work for free. They want to be part of a centrally planned community, attached to the matrix, and getting some kind of electric shock up their rear end every day. But I'm not one of those people. So I actually do like money, and I do like to work hard. I know you guys do too. So buy the book, people. Actually, I do want to add one thought, though, Chris, because you were talking about research and going back and looking at the source documents. And I've probably mentioned this on a podcast before, but one of the places that I found early on, and I don't know if you've ever been there, is the National Agricultural Research Library in Beltsville, Maryland. It looks like an East German prison camp building with no windows alongside the Beltway, about 30 miles outside D.C., but if you can get in there and sweet talk some of those librarians to get up on the stacks, it's amazing what's up there, because the source documents, going through The Economist from the 1800s. I remember walking around the sources, and there was a newspaper just laying on the stacks there the day after Lincoln had been killed. And you're like, wow, thank you for the access. This is really cool stuff. But anyways, FYI. Now, I've just told a few people that story now, so.
I still remember exactly what it smelled like, being up in the stacks of one of UC Berkeley's numerous libraries. I think they have the second largest library of any university in the United States. And I used to have loads of fun doing my research in the various business libraries as a graduate student, when I probably should have been at the particle accelerator. But that was kind of my clue that maybe my love wasn't for for physics, nuclear physics, but really more for stock market and analysis and charts and all that good stuff.
I'm gonna keep jumping on you guys, because as I've been going through your book, I've made all kinds of notes here, and I've scribbled all over everything here. But I have one phrase or a sentence that you guys asked the audience, and I want you to run with this. So it says, and this is from your book: what mental clutter in the way of fears, biases, concerns, and more is building up in your mind and getting in the way of clear and decisive decision making? That's a loaded statement.
Yeah, and that's a pretty comprehensive question, because someone would have to be very honest about looking at exactly what does affect them. And I think a lot of people go through life not recognizing what causes stress or what causes fear, and in turn causes them to make the wrong decision, regardless of whether it's investing or anything else in life. And so that question is really trying to get someone to look in the mirror really hard and take an honest look at what might be driving them under the surface. And even I find as a trader, I think, Chris, same thing with you, even today we find that there are things that lurk there, and unless you're actually constantly working on your brain to dig them out and to identify them, they can lurk there and actually hamper you. And then it's definitely a process of cleaning, keeping your head clear and clean, and going in and doing a cleaning process every once in a while. And, that's where the spiritual aspect of trading comes in for us. And that'll be the topic of the book after the next book, I think it is, right, Chris?
Yeah, that's right.
So, so yeah, it is a loaded question, but that's a question that I think everybody has to ask themselves at the outset of the investing process when they decide they're going to put some money at risk. And I don't think they ever even bother to delve, even on the surface of that at all.
Well, let me give a shout out to my friend because he gave me this example, and his name is Tim. I won't say his last name, but it starts with a D. So Tim, hopefully you're listening and you're going to see that I'm calling you out for not listening in prior podcasts. But Tim sent me an email yesterday, and I guess he had made all kinds of assorted short option bets and this and that, and he was like lamenting that all of a sudden there was a fiscal cliff deal, and that he lost all the money because he made the wrong bet. And, he's a pretty experienced guy. He's a sharp guy. But he was falling prey to the idea that he thought there was some way he could be clever about building a profit-making strategy around what was clearly going to be a news event that was going to go one way or the other. And he basically was lamenting that he bet too much. So maybe in the context of the question that I was reading from your book, talking about the biases and the fears and whatnot, maybe you can relate what I just told you about Tim and to the audience as a whole as to, how would you have analyzed his decision-making and his biases and his fears that, even though an experienced guy was reaching out and trying to do something that deep down he knew was really like flipping a coin?
Well, the thing is we've been in a gap up, gap down news environment, and I think it's gone hyper reality really at the end of 2012 as the fiscal cliff deadline neared. And we know that any kind of news that shows that we're getting closer to resolution or further away is going to cause a lot of volatility in the market. The volatility was clear if you look at all these prior situations when you got news-driven type of environments. And I would say that the fiscal cliff issue was one of the mother of all those types of environments. So for someone to put a big bet on one way or the other, they really need to examine, first of all, how much they're going to lose, how much they can afford to lose, and what the market could end up doing if the cliff is resolved or not resolved. In other words, they should know damn well that if they say that if they're short the market and they think that the market's going to collapse, well, what if the resolution, what if they come to resolution before the deadline? How much is the market going to gap up? Well, they should study history, and they should say, well, maybe the market's going to gap up 5% maximum. So if they're in a 3x ETF, that they could easily lose 20% off their trade. So how much of their trading capital do they want to lose overnight? Is 20% reasonable for them if they're going to play this kind of bet? Gil and I ended up just staying in cash because it was too much like betting on red night in Vegas.
Right, and I think that's a great example of a very fundamental flaw in a lot of people's thinking in terms of approaching any investment, and that is they become overly optimistic. So, when you think about it, buying a stock for most people is a very optimistic process. You say, oh, I like this stock, it's going to make me money, and I'm going to buy it. You certainly don't buy a stock to lose money. So I think what he did, he made a very fundamental error that he did not consider what would happen coming into the trade with too much optimism and only considering a successful outcome without considering entirely, what an unsuccessful outcome would do in terms of a loss. But, that's also common. And like I was saying, as a trader, I've got almost 22 years experience as a trader. And so I make fewer errors, but when I do make errors, they tend to be much more spectacular. And it seems like maybe that's what your friend fell into with that decision to bet on the outcome of the fiscal cliff negotiations.
Yeah. I'm going to keep jumping around on you guys because now I've got you here. I might as well just get you to educate the audience. So when you guys hear the word expensive, so somebody's out there and they come to you, student, client, and they're saying, well, the market, I'm going to get subjective. The market feels expensive. Now, there's probably some heavy duty psychology that needs to be worked on with those two words alone, feels expensive. Why don't one of you guys take that and run with that and break that down to its essence as to why just the simple two words combined, feels expensive, is like something, there's an attitudinal adjustment is needed right then and there.
I would say that that's definitely the common error there is what I would call price bias. And people are looking in terms of absolute prices or where something is in relation to where it's been rather than where it's going. And so they decide that something feels expensive because, let's say, it's a 3-digit price stock like Apple, say. I remember when Apple was around 300 or 400, people would say, oh, I can't buy Apple. It's too expensive. It feels like an expensive stock. And I suppose, in terms of all those numbers it is, but really that's not really important. What's important is where's the trend. Once you buy a stock, where's the trend and which direction is it going to go from there? And people should be less concerned about whether something looks or feels expensive because generally the higher it goes, the more expensive it gets. And that could keep you out of a great trade that way.
Greenspan in 1997 made his famous irrational exuberance speech. And I remember that shook the markets. And a lot of people felt, yes, everything's way overpriced. But of course, we all know that the big bull market of 1990 did not end until March of 2000. And if anyone let that kind of news item derail them from their positions, they missed out on some of the biggest profit opportunities the market's seen in 50 years. Now, the flip side of saying it feels expensive is to say, oh, this looks like a deal. This looks like a bargain. It's cheap. It used to trade at 30. Now it's trading at 20. And of course, we know that is a recipe for disaster because if a stock is trading well below its prior peak price, and it may even be on a downtrend, or maybe it's had a gap down, or maybe the gap down is yet to come. I've rarely ever been in a stock that gapped down on me simply because when a stock starts to weaken, and this is where the 7-week sell rule comes in, when it starts to weaken and starts to violate some critical support areas, you want to be out of that stock. Something's not right. Often the news item doesn't hit until weeks after the stock is topped, and then the bad news comes out, and then the stock loses half its value overnight. I'm very happy to say that I think I've only been caught once in a stock that gapped down, and it was an odd one because it was actually hitting new price highs and then gapped down the next day. So that kind of pattern is incredibly rare, fortunately, in the market. And so, being involved in a stock like that is like I said, I've been doing this for years and years, and I've only been caught, I believe, one time on a gap down.
So I'm going to get you guys to go with some concrete examples. And while I'm telling you a quick example, you guys can put your thinking cap on and maybe add some others. I remember the classic example when I was putting my first book together was Enron. And Enron, and I don't remember the exact numbers, but let's say it was roughly trading around 90. And I think that might have been at the time where people figured out they had a fake trading floor. And then Skilling resigned when it was trading about 50. And then when it got to about 2, all the pension fund managers and Granny were complaining and barking to the press that they had gotten scammed. And I was thinking to myself, hold on. They told you they had a fake trading floor at 90. The president resigned at 50, and you still own it at 2, and you're complaining.
That's like the guy, I saw a guy on TV right around that time when the stock was trading at 3, I believe, and he had won the Texas lottery, and I think he won $30 million. I asked him what he was going to do with the money, and he said, I'm going to buy Enron stock because it's cheap.
That's awesome. I hope he did. I hope he did because it got cheaper.
Yeah, it got a lot cheaper, and he lost all his winnings, so it's a nice way to squander it. But, there's the mentality again.
Yeah, it's interesting because Enron stock, it was doing well all the way up until really the 2000s and the year 2000, and then when it started to violate the 10-day, and the 50-day, and then the 200-day moving average, and it had a nice downtrend that lasted the better part of a year, where there was lots of opportunity to sell before all hell broke loose. Because at the price points, it peaked at about 90 a share, and then this downtrend set in, and then it was all the way down to 30, so it lost 2/3 of its value. But the real sell-off didn't occur until a couple weeks later, when it went from 30 all the way down to just a few pennies.
Mm-hmm. Gil, you brought up a great example with the lottery, and I did a segment on that in my film, and specifically the notion of sometimes people that have this found money. I mean, you see these you could find the examples all over the internet, all over the press, that often these lottery winners, just like pro athletes, lose all of their money. You give somebody $30 million, you give someone $100 million, you give a pro athlete $50 million, they are going to be broke with inside 3, 4, 5 years. In fact, there's a great ESPN 30 for 30 show about pro athletes just sitting there and lamenting how they lost all their money. I don't know. Maybe you could run with that a little bit on the psychology side of it.
I think they probably just make a lot of bad decisions in terms of thinking, well, I've made all this money, and they get an air of invincibility to them. Either their earnings power is going to continue like it has, and they just get sloppy with it. And they think that they can, win magic or weave magic with their money no matter what they do, because they've just shown what kind of prowess they have in terms of earning it, or even just hitting something like the lotto one time and making it. So there's this sort of detachment from the reality of what just happened, in terms of being either in the right spot at the right time or having a trade that worked. I remember after 99 in the early 2000s, remember this, Chris, a lot of guys had made a lot of money, and they began to think that it was them that was smart and not the market. And so they got very sloppy with their trading, because they literally believed they could, buy anything and it was going to double, because that would have been their experience. And so I think people lose, once something comes to them easily, they lose sight of exactly what it took to get that in the first place. And they don't remain mindful of that. That was one thing O'Neill taught me about the trading business, is that he said, you'll have periods where you make a lot of money. And when you do, make sure you put a lot of it away, because there will be times when you don't make very much, or where you lose, and you always want to be in a position to come back. And I think people just, something comes easy and they go crazy and they go over the deep end. I've seen that happen with a lot of people. I think Chris probably has seen more people like that.
Yeah, absolutely. Actually, it brought to mind something in myself over the years, because I've been doing this since I was interested at the age 11. And I thought I'd figured out the market at age 15, age 18. I mean, I got to tell you, I how many times...
Classic Chris.
Yeah, that I figured it out. And we're talking, we're approaching double digits here. But what was interesting was the second time, third time, fourth time I thought I figured it out, I didn't make that same mistake again. I realized the markets morph, they change. In fact, we'll never figure them out. And that's what keeps them dynamic and interesting to me. And this is why I'm going to be doing this till I drop. I mean, I love this stuff. And, it's every day is a new day. Every day is dynamic and changing. So for all the listeners out there, if you think you've gotten to that point where you figured out the market because maybe you had 8 good years, but examine the market. Has the market been in an uptrend? Has it been, was it like the 90s where you had mostly bull markets? And then study prior histories, study the 70s, study the 30s. See, and get a sense of how well would you have done in those kind of environments. Understand that markets can be bullish, bearish, and trendless, and see how your systems work under those different conditions. I encourage people to do thorough study and burn in midnight oil so they know the weaknesses and strengths of not only their trading system, but also their trading psychology.
Hey, Chris, we haven't had a chance to speak yet. I know Gil and I had done a podcast earlier, and I'll have to get you on for a solo cast here in the future. And I have one main last question I want to ask for our conversation today, but I thought maybe for the audience out there, if you would go ahead and outline for them, you mentioned, 11, being interested in the markets at 11. So it sounds like you were a precocious child, a young man. So why don't you outline at the age 11, beyond being interested in the markets, what were you doing? Were you just what was a young Chris doing at 11 to get interested in the markets? Who inspired you? How did you come to that realization or curiosity at such a young age?
It might be genetic, just like music. My dad believes I composed my first song at age 5, and he says that's entirely genetic. No one told me to do that. I was noodling on the piano when I was 3 years old. Now, when I was, I think it was 6 or 7, I started collecting stamps, coins, and paper money. Not for the same reason kids do that, not for the pretty pictures, but because I had all these different stamp catalogs, and I realized that prices go up, prices go down. And that intrigued me, that I could actually buy something and then resell it later for a premium. And I got very, very scholarly, and I had loads and loads of these catalogs going back years, and I'd study the trends. And so that was exciting to me. And then at age 11, I was interested in precious metals because we had lots of inflation and precious metals were going through the roof. And that was very exciting to me, that I actually bought some silver, ounces, troy ounces of silver, and that you could see the price actually appreciating on you. And then that in turn led into the study of stocks. I bought my first stock, which is Apple Computer, at age 12. And my mom would get daily graphs from William O'Neill and Company. She would get the Wall Street Journal. So I was kind of in an osmotic manner conditioned to absorb some of these studies that my mom would do. I mean, incidentally, when I was 5, my mom would have me write down the ticker symbols and prices as they would come across the ticker tape. And I didn't know what I was doing. I like numbers, and I thought it was fun, but I didn't understand the meaning behind it. But I think doing things like that at such a young age does ultimately leave some sort of impression.
Yeah, I agree. I think I see that in, I don't have kids, but I've seen in young kids, either my nephews, my niece, a friend's little girl, is that exposing children, getting them to see these things beyond just the Xbox and SpongeBob actually has some benefits.
Yeah, absolutely. I believe that. Well, they say, scientifically speaking, the first year of a child's life, they're going to learn more that first year than all the other years combined. And so you could extrapolate that and say, well, when they're 3, 4, 5, 6, 7, 8, these are very critical, precious years. And you might, if you're a good parent, hopefully you will surround them with very mentally engaging music and books and documentaries. Even if they don't understand it on the surface, there's probably some internal learning going on anyway. And I think that it's absolutely critical when a child is in his formative years to have that kind of exposure.
So I'm going to leave you guys with one last question before we sign off here today. And this is getting back into your book. And I thought it was something that caught my eye, the idea of eye candy. And specifically for those people out there that have got a handle on technical analysis, have a handle on trend following, perhaps they're still new and they see all these different indicators and there's software packages out there. And as you guys describe it, there's a lot of eye candy that you can install on whatever platform you want to play on. Why don't you talk about the idea of eye candy when it comes to your world, my world?
I think that a lot of people, especially today, can get swept away by all the information, like that Police song, too much information running through my brain, too much information driving me insane. And people can, I think that's a phenomenon you see a lot today with the internet. There's a lot coming at you. And I think people like that. It's almost like Soma to some extent. And so you see people, at least traders, get caught up with how many monitors they have, monitor envy. And I see some guys with these 10 monitor setups. But from a practical standpoint, what is it you need to see to identify the trend based on your methodology, and how much of what you're looking at is a distraction? And I think it's very important for traders to make that determination, both for themselves and their methodology within the context of their methodology. Because I remember watching Bill O'Neill trade, and he would have a one monitor setup rather, with about 20 quotes, the major market indexes, the S&P, the Dow, the NASDAQ, and then maybe 15 or so stocks, and the type would be about an inch high on his screen. And that's all he would watch. And he made a lot of money. He didn't need to look at oscillators and MACD and all sorts of other fun things. It's very, very simple. And that's where it first hit me, that there's not much you need to look at. Just figure out what you need to look at and how often. And for the most part, some of these trend following guys, they're rarely in the office. If there's nothing going on, they get a signal, they go into the market, and then they're just sitting and not letting all the wonderful flashing lights in the news and whatnot, all the eye candy, as you might call it, because you can actually now get platforms that have a little CNBC screen in the bottom left corner, which is exactly what you need to trade well. And I think people get really caught up with the eye candy, but it's really about knowing yourself, knowing what you need, and also understanding what can distract you. So I remember we got a platform 3 or 4 years ago when I was running another fund. We had a trading platform, and the trading platform would allow you to put quotes up with these red and green bars that would form next to the price. And these were velocity indicators. And so you'd see a big green bar suddenly start to sprout up like some sort of rapid action camera work on a plant or something, on a blade of grass coming up. And I would find myself reacting to that. Really, did I need to see any of that? And really, was that just noise? And I think that's where I came to realization that, I'm looking at way too much stuff here. And I think a lot of people do that.
I was most impressed with O'Neill's ability to just look at the basic price volume of a chart, the chart formation, and use the 50-day and the 200-day moving average and nothing else. And he had trained his eyes over the many, many years that that's all he needed. And that was so much cleaner than when I came to the company and had a lot of bells and whistles going on. And one by one, over the months and then years that ensued, I basically discarded 9 out of 10 of these indicators that I realized were just clutter for my screen. And
Chris, you remember when you had 20-minute delayed quotes, and then Bill came in and told you were going to get real-time quotes, but don't let that throw your trading off.
Oh yeah, and it did. It actually did. It actually I had to adjust to real time, because with 20-minute delay, you're not going to have a knee-jerk reaction to a price change. And so it took some doing for me to get used to the 20-minute delay, to get used to real time. It's a valuable lesson that, simpler is better when it comes to a market environment, because you figure everyone's looking at these real-time quotes, and so everyone's going to have that same knee-jerk response, and maybe it gets exacerbated to the point where you get forced out of your position on a real-time basis. And of course, we use real-time today, and that we know how to work with it. We know how to use it. But I would imagine there's a lot of investors that get thrown because these intraday moves can be sudden and violent. I'm
going to steal this from a trend following trader out of London named David Harding. And he has made the comment that the question is, if you were on a desert island and all you had was the price stream, just the data, just the price data, could you trade that price data and make money if that's all you had? And that's an interesting question.
Yeah, Bill O'Neill told me that if he was on a desert island and he could only have one source of information about the market, all he would need to make money would be weekly charts.
Yep.
So.
Yep. Well, I tell you,
yeah,
that's a great piece of advice, and it probably hasn't changed that much. Listen, today,
no.
I want the audience to know, today I've been speaking with Gil Morales and Chris Kacher, and their new book is In the Trading Cockpit with the O'Neill Disciples. And guys, what's the best place for people to, I know the book's available on Amazon, or it's going to be available on Amazon, or is it, have I already hit the deadline?
It is now. It's already available, I think, yeah.
What's the best way for people to reach you guys?
Just mail us at, go ahead, Chris. You can say it. The email address.
Everyone can go to info@virtueofselfishinvesting.com. That's info@virtueofselfishinvesting.com, or they can go straight to our website. The shorthand would be www.selfishinvesting.com, and they can get a hold of us that way. It's just it's quite simple. And we love, we get sometimes well over 100 emails a day. With people writing in, they have their questions or their queries, whatnot. And we find that's a very efficient way to communicate with the public.
Yeah, I think email is still the best way to communicate for sure. It's
yeah.
But listen, guys, it's been great having you today. And Chris, we will have to go ahead and connect on a solo cast here in the near future. And but great conversation. And thank you for joining me today.
Thanks, Mike.
Michael.
Pleasure.
Take care.
All right, take care.
So
Bye-bye.
long.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.